Michael Burry just did something extraordinary. Not bearish positioning, not a hedge, not even a dramatic public warning. He shut down his entire hedge fund and walked away from Wall Street completely. This is the man who predicted the 2008 housing crash, who made $700 million betting against the entire financial system, who turned his investors' money into 5 times what they started with. And he's leaving, not because he's wrong, because the markets have become so disconnected from reality that he can't operate rationally anymore. Meanwhile, I'm sitting on $334 billion in cash at Berkshire Hathaway, the largest cash position in our 60-year history. Both of us are seeing the same warning signs. Both of us are preparing for something catastrophic. And Bitcoin is going to be absolutely obliterated when this bubble pops. On November 10th, 2025, Michael Burry filed to deregister Scion Asset Management. That's not a routine filing. That's shutting down the entire operation. His explanation was chilling in its simplicity. My estimation of value is not in sync with markets. Read that carefully. He's not saying markets are slightly overvalued. He's saying there's no common language anymore between what things are worth and what people are paying. Before he shut down, he placed a $1 billion bet against NVIDIA and Palantir, 2 of the most hyped AI stocks in the market. Then he walked away. Think about what that means. He saw an opportunity so compelling that he risked $1 billion. But he also saw a market so irrational that he couldn't keep operating in it even with that conviction. Burry's track record demands attention. In 2008, he made $700 million personally betting against subprime mortgages when everyone thought he was insane. His investors who stayed with him from 2000 to 2008 quintupled their money while the broader market barely broke even. This isn't some perma-bear who's always negative. This is someone who sees structural problems before anyone else and acts on them. And his move now isn't retirement in the traditional sense. He's 49 years old. He's in his prime. He's walking away because the market has become too irrational to operate profitably. He filed that deregistration early, bet $1 billion against the AI bubble, and then closed the shop. That sequence tells you everything. He's not uncertain, he's convinced. And he doesn't want to manage other people's money when the crash comes, because the psychological pressure and redemption requests would interfere with positioning. He's going dark to wait out the storm. The AI bubble that Burry is targeting is staggering in its magnitude. Microsoft is spending $120 billion on AI infrastructure in 2025 alone. Amazon is spending $100 to $120 billion. Alphabet is spending $85 billion. Meta is spending $72 billion. Combined, these companies are investing somewhere between $320 and $400 billion in a single year. That's roughly 2% of the entire United States GDP being spent by 4 companies on a technology that hasn't proven it can generate anywhere near the returns necessary to justify that investment. This isn't rational capital allocation. This is a competitive arms race where every player is terrified of being left behind. Remember when Sundar Pichai said the risk of underinvesting in AI is greater than the risk of overinvesting? That's not the language of a disciplined capital allocator. That's the language of fear. That's someone saying, we have to spend because everyone else is spending, not because we've calculated a positive return on investment. And here's something almost nobody is talking about: the depreciation fraud happening in plain sight. Big tech companies are systematically extending their depreciation schedules to make earnings look better than they actually are. Server lifespans are being extended from 4 years to 5.5 years across the industry. That might sound like a technical accounting change, but it's material. By understating depreciation, these companies are going to inflate earnings by approximately $176 billion between 2026 and 2028. Meta and Oracle are particularly egregious, inflating their profits by 20 to 27% through these gimmicks. When you're stretching asset lifespans to make quarterly numbers look better while simultaneously spending hundreds of billions on new assets, you're playing a shell game. You're borrowing from future earnings to inflate current earnings. And when the music stops and reality hits, the corrections are going to be savage. My parallel actions at Berkshire should terrify anyone paying attention. I sold $134 billion worth of stocks in 2024. $134 billion. That's not rebalancing a portfolio. That's exiting positions on a scale that I've never done before in 6 decades of managing money. I cut our Apple position by 70%, even while publicly calling it the best business I know. I trimmed Bank of America by 41%. These aren't distressed companies. These are among the best businesses in the world. And I'm selling because I can't find anything worth buying at current prices. When I can't deploy capital productively, when every valuation analysis tells me assets are overpriced, when the risk-reward doesn't favor ownership, I raise cash. That's discipline. And right now I have more cash than I've ever had because I can't find value anywhere in this market at these prices. The Buffett indicator is screaming danger at levels that should make your blood run cold. The total market cap to GDP ratio is currently at 209%. Let me put that in context. The only other time in American history this ratio was this high was 1,929, right before the Great Depression. The dot-com peak, which everyone remembers as an insane bubble, was 140%. We're 50 percentage points higher than that. We're asking every dollar of GDP to support over $2 of stock market value. That's mathematically unsustainable. The NASDAQ to M2 money supply ratio is even more alarming. It's currently at 176%. During the dot-com bubble peak, it was 131%. We're 45 percentage points higher than the most spectacular tech bubble in history. These aren't close calls. These aren't yellow flags. These are 5-alarm fire warnings that the market is grotesquely overvalued by historical standards. The capital expenditure arms race in AI reveals the fundamental irrationality of current market dynamics. Companies aren't spending $400 billion because they've calculated clear returns. They're spending it because they're terrified their competitors will gain an advantage. Sundar Pichai's quote about the risk of underinvestment being greater than overinvestment exposes the psychology. That's herd mentality, not financial analysis. You want to know if returns are there to justify this spending? Run the numbers. $400 billion in capital spending needs to generate at least $60 billion in annual profit to achieve a 15% return, which is the minimum you should demand for risky technology investments. At a 20% profit margin, which is generous for technology services, you need $300 billion in new annual revenue to hit that $60 billion in profit. Where is that $300 billion coming from? Current AI-specific revenue across the entire industry is in the tens of billions, not hundreds. Maybe some companies are generating 30 or 40 billion from AI products and services. We're nowhere close to the hundreds of billions required to justify the investment. The gap between investment and return is widening, not closing. This is the definition of a bubble. The telecom parallel from the late 1,990 seconds should be required reading for anyone investing in AI infrastructure today. Telecom companies spent over $500 billion laying fiber optic cable in the late 1990 seconds. They were building the information superhighway. The future was fiber. Every analyst and every executive agreed that whoever controlled the fiber controlled the future of communications. And then reality hit. By 2002, only 5% of all that fiber was actually being used. Dark fiber everywhere. Massive overcapacity. Global Crossing went bankrupt. WorldCom went bankrupt in the largest corporate fraud in history. Shareholders were completely wiped out. The same pattern is playing out now with AI data centers. Companies are racing to build capacity far beyond what the market can absorb. They're doing it because competitors are doing it. They're stretching depreciation schedules to hide the true cost. And when demand doesn't materialize at the pace needed to justify the investment, the write-downs and bankruptcies will follow. The economics of data centers don't work at the scale being contemplated. A 1 gigawatt data center costs approximately $50 billion to build. The GPUs inside depreciate rapidly, even with extended accounting schedules. The electricity costs could actually exceed the hardware costs over the facility's lifetime. And you're competing with well-funded rivals offering similar services in a race to the bottom on pricing. Where is the sustained profit in that business model? Palantir's valuation is so insane that it deserves its own category of irrationality. The P/E ratio ranges from 400 to 500 on a trailing basis and 175 to 204 on a forward basis. The software industry average P/E is 45 to 50. Palantir is trading at 3 to 4 times its peer group valuations. To justify current prices, earnings need to grow 300 to 400%. Show me the path to that. Show me the customers, the contracts, the pricing power, the margin expansion that gets you there. You can't, because it doesn't exist. NVIDIA seems more reasonably valued with a P/E around 54 until you realize those earnings are based on inflated accounting, as I discussed earlier. And the competitive threats are mounting. China is developing domestic chips specifically to reduce dependence on NVIDIA. AMD is competing effectively in the same markets. Google and Amazon are designing their own AI chips for internal use. NVIDIA has 80% market share in AI chips. That can only go in one direction. And when market share erodes and pricing power declines, that 54 P/E will look expensive very quickly. The Magnificent Seven concentration risk is extraordinary and underappreciated. 7 companies, Apple, Microsoft, Google, Amazon, NVIDIA, Meta, and Tesla, represent 30% of the S&P 500's total value. That's $23 trillion. The entire United States GDP is $29 trillion. 7 companies are worth nearly as much as the entire economic output of America. Does that seem reasonable? Does that seem sustainable? It's the definition of a bubble when a handful of companies command valuations normally reserved for entire economies. When the AI bubble pops, crypto gets caught in the crossfire because all speculative assets crash together. Risk off isn't selective. When institutions are forced to raise cash, when leverage unwinds, when fear replaces greed, everything speculative gets sold. Bitcoin is already down from 126,000 to 80,000. That's a 36% drop. But we're talking about a 90% crash from the peak. That would take Bitcoin to $12,600. From current levels around 80,000, it would be around 8,000. Is a 90% crash unprecedented? No. Bitcoin crashed 77% in 2022. It crashed 84% in 2018. The infrastructure was less developed then. The market was less liquid. But the pattern is clear. When speculative fervor breaks, crypto crashes harder and faster than anything else because it has no fundamental floor, no cash flows to catch the fall, no intrinsic value. It's pure sentiment all the way down. Let me walk through the math of a 90% crash so you understand the magnitude. From the peak of 126,000, a 90% decline means Bitcoin trades at 12,600. From current levels around 80,000, it means 8,000. The total crypto market cap would drop from 4.4 trillion to 440 billion. $4 trillion in supposed wealth evaporates, completely gone, never existed except as numbers on screens based on marginal trades. What triggers the final fall? Several catalysts are converging. The Federal Reserve keeps interest rates high for longer than markets expect because inflation remains sticky. A recession hits, forcing institutions to liquidate speculative positions to meet redemptions and margin calls. MicroStrategy gets reclassified by MSCI on January 15, 2026, which forces index funds to sell their holdings, creating a cascade of selling pressure. And leverage unwinds in what traders call a face-melting liquidity vacuum where there are no bids and prices gap down violently. Any one of these could trigger the crash. All of them together creates a perfect storm that Bitcoin cannot survive intact. The leverage in the crypto system is enormous. When that leverage unwinds, when positions get forcibly liquidated, the price discovery process is brutal and fast. We saw a preview in October and November. The real thing will be worse. Here we have two legends, Michael Burry and myself, sending the same warning from different angles. Burry is actively betting against it and walking away from Wall Street because it's too irrational. I'm raising record cash and waiting for the crash to deploy capital into real value. We're both seeing the same structural problems, the same overvaluation, the same speculation masquerading as investment. The 90% crash isn't a wild prediction. It's a historical pattern. It's what happens when speculative bubbles built on leverage and momentum meet reality and mathematics. Be ready for what's coming. Don't be caught holding something that produces nothing when the tide goes out. Don't be the person who convinces themselves this time is different. It never is. The crash is coming. The only question is exactly when and whether you'll be prepared or devastated. Let me add more context about why this specific moment is so dangerous. The confluence of factors we're seeing, the AI spending bubble, the crypto mania, the stretched valuations, the accounting games, the leverage, the herd behavior, these don't happen in isolation often. When they all converge, the crashes are generational. 1,929, 2,000, 2008. These weren't normal corrections. They were paradigm shifts where 20, 30, 40% of supposed wealth evaporated and took years to recover. We're setting up for another one. The behavioral dynamics are crucial to understand. When everyone is positioned the same way, when everyone believes the same narrative, when everyone is leveraged in the same direction, the reversal is catastrophic. There's no one on the other side to buy. There's no natural floor. The price discovery process becomes a race to find any bid at any price. That's when you see 90% declines in individual assets and 50% declines in broader markets. Burry's bet against NVIDIA, and Palantir specifically, is telling. He's not betting against the entire market broadly. He's targeting the most overvalued, most hyped, most momentum-driven names. That's where the crash will be worst. And when those high flyers collapse, they take everything speculative down with them. Bitcoin, crypto broadly, meme stocks, unprofitable tech. It all gets sold in the panic. The beauty of his walking away is that he won't be subject to redemption pressure when the crash happens. When you're managing other people's money and the market drops 30%, investors panic and demand their money back. That forces you to sell at the worst possible time to meet redemptions. By shutting down now, Burry controls his own timeline completely. He can hold his short positions through the volatility without worrying about forced liquidation. I'm in a similar position with our cash pile. We don't have redemption concerns. We don't have margin calls. We don't have quarterly performance pressure. When the crash comes, we'll have $334 billion ready to deploy into assets trading at a fraction of their intrinsic value. We'll be buying when everyone else is forced to sell. That's how you compound wealth through cycles. The AI spending boom is revealing because it's almost entirely defensive. Companies aren't spending because they've identified clear profit opportunities. They're spending because they're terrified of being disrupted. Fear is a terrible investment thesis. Fear leads to waste, to overcapacity, to bad decisions, to following the herd off the cliff. Rational capital allocation requires saying no to projects that don't meet return thresholds, even if competitors are doing them. But nobody wants to be the one who missed AI, so everyone spends regardless of returns. When this ends, the recriminations will be brutal. Boards will demand answers about why hundreds of billions were spent with minimal returns. Shareholders will revolt. CEOs will be fired. And the stocks will collapse as earnings disappoint and write-downs hit. The bigger the hype on the way up, the bigger the crash on the way down. And AI hype has reached levels that make the dot-com bubble look rational by comparison. The crypto crash will be particularly savage because so many retail investors are involved. These aren't sophisticated institutions with risk management and diversification. These are individuals with their life savings, their retirement accounts, money they can't afford to lose, betting on getting rich quick. When the crash comes and their portfolios drop 80 or 90%, the human toll will be devastating. And there's no bailout coming, no government rescue, no too big to fail protection. Crypto investors are completely exposed. Michael Burry and I are both preparing for the same crash from different angles. He's actively shorting the bubble. I'm passively waiting with cash, but we're both convinced it's coming. Two of the most successful investors of the past 50 years, both seeing the same structural problems, both positioning for massive market disruption. That should tell you something. When the smartest people in the room are heading for the exits, maybe you should too. Don't be the last one in the burning building hoping the fire department arrives in time. Get out now while you still can. The depreciation accounting issue deserves much deeper examination because it reveals how desperate these companies are to maintain the growth illusion. When you extend the useful life of server equipment from 4 years to 5.5 years, you're reducing annual depreciation expense by about 27%. That flows directly to the bottom line as artificially inflated profit. But those servers don't actually last longer just because you changed an accounting assumption. The economic reality is the same. The hardware still degrades at the same pace. The refresh cycle still needs to happen. You're just deferring the expense recognition to make current quarters look better. Meta and Oracle doing this to inflate profits by 20 to 27% is accounting fraud in spirit, if not in letter. They're meeting the technical requirements of GAAP while violating the spirit of honest financial reporting. And when hundreds of billions in AI equipment starts hitting the end of its actual useful life, while the books still show years of remaining value, the write-downs will be spectacular. Investors will wake up to realize that reported earnings were overstated by 20 to 30% for years. The stock crashes won't be overreactions. There'll be appropriate corrections to reality. My Apple selling deserves more context because people keep misunderstanding what it signals. Apple is genuinely one of the best businesses in the world. Incredible brand loyalty, pricing power, ecosystem lock-in, fortress balance sheet, brilliant capital allocation under Tim Cook. I love everything about the business. But at current prices, with current market multiples, even Apple isn't cheap enough. That should terrify you. If the best business in the world at a below-market multiple isn't worth holding, what is? The answer is nothing. Everything is overvalued. So I'm selling great businesses and raising cash because discipline matters more than loyalty to positions. People want to believe I'm selling for tax reasons or because I'm bearish on Apple specifically. Neither is true. I'm selling because the opportunity cost of holding stocks at these prices exceeds the returns I expect them to generate. When I can earn 5% risk-free in Treasury bills and stocks might return 5 to 7% with massive downside risk, the math says sell and wait for better opportunities. The Buffett indicator at 209% should end all debates about valuation. This single metric has predicted every major market crash for the past century. When it exceeded 140% in 2000, the market crashed 50% over the next 2 years. When it was elevated in 2007, the market crashed 57% in 2008 to 2009. We're at 209% now, 50 percentage points higher than the dot-com bubble. And people are acting like everything is fine, like we've entered a new paradigm where stocks can trade at 3 times GDP forever. It's insanity. The NASDAQ to M2 money supply ratio being 45 points higher than the dot-com peak is equally damning. Money supply growth has been restrained. The Fed isn't printing money like in 2020 to 2021. So stock prices rising to 176% of M2 means pure speculation driving values, not monetary inflation. This is investors paying ridiculous prices because they think prices will go higher, not because any fundamental analysis justifies it. The data center economics failure is inevitable and predictable. You can't spend $50 billion building a 1 gigawatt facility, stuff it with GPUs that depreciate rapidly, consume electricity that costs hundreds of millions annually, and then compete with 3 other companies doing the exact same thing in a race to the bottom on pricing. Where's the profit? Where's the sustainable competitive advantage? There isn't one. These facilities will become stranded assets, white elephants that nobody wants to own when the AI hype fades and actual usage falls short of projections. Palantir at 400 times earnings is beyond bubble territory. It's pure mania. To put it in perspective, at the peak of the dot-com bubble, Cisco traded at 150 times earnings, and people thought that was insane. Palantir is trading at 3 times Cisco's peak bubble valuation. And Cisco had real revenue, real customers, real networking equipment that was essential infrastructure. Palantir has government contracts that could disappear and software that faces increasing competition. The comparison is absurd. For Palantir's stock price to be justified, earnings need to grow 300 to 400% from current levels while the multiple stays constant. That's not happening, ever. There's no path to that kind of growth at their scale with their business model. So either the multiple contracts 75% or the business performs impossibly well. The first is certain, the second is fantasy. Anyone holding Palantir at these prices is going to learn a very expensive lesson about paying any price for growth. NVIDIA's competitive threats are mounting faster than the market appreciates. China has made semiconductor independence a top national priority. They're pouring hundreds of billions into domestic chip development specifically to reduce dependence on American suppliers. When they succeed, and eventually they will because they have infinite resources and determination, NVIDIA loses one of its largest markets. AMD is already taking share in gaming GPUs and starting to compete in data center chips. And the biggest threat is hyperscalers like Google and Amazon, designing custom silicon optimized for their specific AI workloads. Why pay NVIDIA premium prices when you can design exactly what you need in-house? NVIDIA's 80% market share is the peak. It can only decline from here. And when market share starts falling, while competition intensifies and China develops alternatives, that 54 PE will look ridiculous. Fair value for NVIDIA is probably 20 to 25 times earnings as a mature semiconductor company facing increasing competition. From current levels, that's a 50% decline before accounting for any earnings miss. The Magnificent Seven concentration is the most obvious sign we're in a bubble that I can point to. Throughout history, when a handful of companies dominate market cap to this degree, when they're worth as much as entire economies, when everyone believes they're permanently dominant, that's the peak. It happened with Nifty 50 stocks in the early 1970 seconds. It happened with Japanese stocks in 1989. It happened with dot-com stocks in 2000. And it's happening now with the Magnificent Seven. These companies might remain good businesses. Some probably will. But the stocks will crash because they're priced for perfection while facing massive risk. When trillion in market cap concentrated in 7 names starts to crack, the selling will feed on itself. Index funds will be forced sellers. Retail investors will panic. Institutions will rush for exits simultaneously. And there's not enough liquidity to absorb that selling at anywhere close to current prices. When I combine the AI bubble popping with the crypto crash, the triggers for Bitcoin's 90% decline become clear. Institutions holding Bitcoin will be forced to sell to meet redemptions from their equity funds. Retail investors who are long both AI stocks and crypto will get margin called on both simultaneously. The narrative that Bitcoin is somehow independent of traditional markets will be exposed as false. Everything speculative crashes together because it's all driven by the same forces: excess liquidity, leverage, momentum, and greed. The MicroStrategy MSCI reclassification on January 15, 2026 is a specific catalyst worth watching. MicroStrategy has become essentially a levered Bitcoin proxy. When they get reclassified, index funds that hold them will be forced sellers. That creates downward pressure on the stock, which creates selling pressure on Bitcoin because MicroStrategy holds so much. It's a reflexive loop where falling Bitcoin prices hurt MicroStrategy, which forces more Bitcoin selling, which hurts Bitcoin more. These leverage-driven death spirals are how you get 90% crashes in weeks instead of months. The face-melting liquidity vacuum that traders fear is what happens when leverage unwinds in an illiquid market. Everyone tries to sell at once. There are no bids. Prices gap down 20, 30% in minutes because there's nobody on the other side. Circuit breakers don't exist in crypto. The market can just keep falling until it finds natural buyers. And when you're talking about an asset with no intrinsic value, no cash flows, no earnings, the natural buyers might be at 000 or 000 or even lower. Michael Burry understands this dynamic viscerally from 2008. He watched subprime mortgages that were rated AAA trade at pennies on the dollar when the market finally recognized they were garbage. He knows how fast confidence can evaporate and how brutal the price discovery process is when everyone wants out simultaneously. That's why he's positioned short and walked away. He's not trying to time the exact top. He's positioned for the inevitable crash and removing himself from the noise. I'm doing the same thing from a different angle. I can't short markets the way Burry can because of Berkshire's size and regulatory constraints. But I can raise cash, which is effectively the same thing as being short when everything is overvalued. When the crash comes, my cash will buy 4 or 5 times as many quality businesses as it can today. That's my return, the optionality to deploy at much better prices after the panic. Both of us are making the same bet from different directions. Both of us have built careers on being right when conventional wisdom is wrong. Both of us are seeing the same signals. When two investors with our track records are this aligned in viewing the market as catastrophically overvalued and preparing for a crash, you should listen. Pride comes before the fall, and the market has never been more prideful or more confident that this time is truly different. It never is. The historical pattern of crypto crashes provides a roadmap for what's coming. In 2018, Bitcoin fell from 000 to 200, an 84% decline. That took about a year to play out fully. In 2022, it fell from 000 to 000, a 77% decline over about 8 months. Both times, people said it couldn't possibly drop that much. Both times, the believers held on thinking it was just a temporary dip. Both times, they were catastrophically wrong. A 90% crash from the 000 peak takes Bitcoin to 600. From current levels around 000, it would be 000. And there's actually no fundamental reason it couldn't go lower. There's no earnings floor. There's no book value. There's no replacement cost. The price could stabilize at 000 or 000 or even back to triple digits if the speculative fever breaks completely. 0 is the mathematically correct value for an asset that produces nothing and exists only by agreement. The wealth destruction will be staggering. $4 trillion evaporating from crypto market cap means real people losing real money. Retirement accounts decimated, college funds gone, life savings wiped out. And there's no Federal Reserve rescue coming, no FDIC insurance, no government bailout. Crypto investors will bear the full brunt of their speculation, and many will be financially destroyed. Burry's timing has historically been early, but eventually proven correct. He started betting against subprime in 2005, years before the crash. He endured ridicule and redemptions while he waited. But he was right. He's making his bet against the AI bubble now in late 2025. Maybe the crash starts in early 2026. Maybe it takes until late 2026 or even 2027, but it's coming. The structural imbalances, the overvaluation, the leverage, the herd behavior, all the ingredients are in place. I'm positioning similarly with patience. I don't need to time the exact top. I just need to avoid being invested in overvalued assets when the crash comes and have capital ready to deploy when things get cheap. That's the position I'm in now with billion in cash. When everyone else is panicking and selling at any price, I'll be buying the best businesses in the world at 50 cents on the dollar. The regulatory triggers could accelerate the timeline. If the SEC cracks down on crypto exchanges or declares certain tokens to be securities, if Congress passes restrictive legislation, if China bans Bitcoin again more effectively, if the EU implements harsh regulations, any of these could be the catalyst that breaks confidence and starts the cascade. Crypto operates in a regulatory gray area that could turn black overnight. The energy concerns around Bitcoin mining are also underappreciated as a risk factor. Bitcoin's energy consumption is unsustainable and increasingly politically problematic. Environmentally conscious investors are divesting. Regulators in multiple countries are examining restrictions on proof-of-work mining. If enough jurisdictions ban or restrict Bitcoin mining for environmental reasons, the network's security could be compromised, which would destroy confidence. When I think about Bitcoin's final fall, 90% is actually conservative. It could easily be 95 or 99%. The only thing preventing total collapse is a small group of true believers maintaining the network and holding their coins regardless of price. As long as those believers exist, Bitcoin probably never goes to exactly zero. But going from 000 to 000, or is functionally the same as zero for anyone who bought in the past few years, the lesson here transcends Bitcoin and crypto. The lesson is about speculation versus investment, about herd behavior, about believing narratives instead of analyzing fundamentals, about the dangers of leverage and momentum trading. These lessons have been taught repeatedly throughout market history, and people still refuse to learn. They always think this time is different. They always believe they're getting in early on the next big thing, and they almost always lose money. Michael Burry and I are both trying to warn people in our own ways. He's betting against it actively. I'm raising cash and speaking publicly about the risks, but most people won't listen. They'll hold through the crash, hoping for a recovery. They'll buy the dip repeatedly as it keeps falling. They'll average down until their accounts are empty. And then they'll swear off investing entirely, having learned the lesson the hardest possible way. Don't be that person. Don't let greed override common sense. Don't let FOMO drive you into positions you don't understand. Don't speculate with money you need. And above all, don't confuse a bubble with an investment opportunity just because prices are rising. The final fall is coming. Be prepared or be destroyed.